Hello. It is 12 o'clock, so we will start moving. My name is Allison Dutcher, and I'm excited to introduce Erin Staufer, who is going to be teaching this wonderful class for first-time home buyers. This will be recorded, and the PowerPoint will be sent after. It normally takes about 24 hours for that to happen. If you have any questions throughout the presentation, there is a Q&A button, and please, any questions that you have, let us know. I will turn my screen on so Erin knows to pause. I'll make sure that your question gets answered. But with no further ado, I'm super excited to introduce Erin. He is a sales manager with Elevations Credit Union. He is a producer. He is an incredible resource, and I'm really excited to be here and allow this and aggregate the questions of this wonderful webinar. So with no further ado, take it away.
Beautiful. Thank you so much. So thank you so much for spending your lunch with me. As Allison mentioned, I've been in mortgage industry now for 16 years. It's kind of a weird thing to be passionate about, but I certainly am. I love helping people get into homes. I truly believe in building wealth through real estate. So yeah, it's a weird thing to be passionate about, but passionate about it I am. When I'm not doing mortgages or teaching other loan officers how to do mortgages, I love to play soccer. I love to do yoga. I bought a motorcycle with a sidecar at the very beginning of the COVID-19. It was kind of my pandemic present to myself. So you'll see me running around town with my Irish setter Finian in the sidecar. He absolutely lives for it. So yeah, if you ever see an Irish setter in a sidecar, that is Finian. And I am his, as far as he's concerned, driver. That's basically all I am to him. So here's what we're going to be talking about today. We're going to be talking about different mortgage options. We're going to be talking about loan considerations, what all impacts what you could ultimately get qualified for, the pre-approval process itself, and then we're going to turn our attention to the home buying process. So once you actually get the financing lined up, what does the actual home buying process look like? Talking about working with an agent, shopping for a home, the collateral, which is the property you're buying. We're going to be talking about the contract process as well. What does that actual process look like? And then closing. So it is a very broad topic. There's a lot to get into. It's also my favorite topic because it does cover so much information. And I especially like it at this time of year. Usually we get a pretty strong turnout for these seminars at the beginning of the year because everybody kind of sets like a New Year's resolution of, hey, I want to buy a house this year. And yeah, without further ado, let's get into it. So in mortgages, there's ultimately three different buckets that mortgages fall into. Okay, there's conventional, government, and portfolio. And depending on which of the buckets the mortgage is falling into, they are going to dictate, ultimately, they're called the investor. The investor is going to dictate to the lender what the rates are, what the guidelines are, what basically the lender needs to do to make sure that their loan is ultimately sellable to, in this case, Fannie Mae and Freddie Mac. They are the government-sponsored enterprise behind a conventional loan. Every time you hear a conventional loan, all they're saying is really, hey, these loans are supported by Fannie Mae and Freddie Mac. They are the investor behind the loan. They're the ones that are doing quality control to make sure that the loan meets their guidelines. Government is actually truly the government. FHA, Federal Housing Administration, USDA, U.S. Department of Agriculture, VA, Veterans Affairs, all truly Uncle Sam's money that you are borrowing. They're the ones that establish the guidelines. They're the ones that ultimately buy the piece of paper behind the loan once it closes. And then a portfolio loan. Anytime you've gotten a credit card or a car loan, those are all portfolio loans. It's all the bank or credit union's own personal money that they're lending out. They get to dictate what the rates are, what the costs are, what the terms are, what the qualification is, all of that. So each of these three different options aligns with ultimately who is the entity behind the loan, who's ultimately establishing what those guidelines are. We're going to be spending the majority of our time talking about conventional financing for a couple reasons. One, it's the most lenient with regards to down payment for a first-time homebuyer. And two, they also have the best rates and the best costs typically. So we're going to be looking at conventional. The vast majority of buyers that are qualified to buy a house look at conventional mortgage. It is the gold standard for mortgages. Now, within each of these three different buckets, there's also different mortgage options. There's different structures to your loan. Most people are familiar with the most common, which is a 30-year fix, right? The rate is fixed for 30 years. The principal and interest portion of the payment is going to be fixed for 30 years. It's not going to change anything. There's also shorter term loans like a 20, 15, and 10 year. Those are all very standard loan terms. Then we have what we call a hybrid adjustable rate mortgage, called a hybrid ARM, like the arm that's attached to your body. Now, ARMs are slightly different. Okay, they're going to have an initial period of time where the rate is fixed, and then after that, the rates are going to begin to adjust. Okay. The most common ARM types are a 3-year, 5-year ARM. That means the rates are fixed for 3 years or 5 years before they start to adjust. 7-year or 10-year ARM, so again, fixed for 7 years or 10 years before they adjust. Then, to make things even more confusing, there's also different structures within the ARMs. Okay, the government requires lenders disclose to buyers how often they can adjust, and when they do start to adjust, how much can that adjustment be. So they're going to follow a typical format of 215 or 515. That means the rate is fixed for 3 years or 5 years. Starting in the adjustment period, it can adjust up to 2% above the initial rate. That's what the first number stands for, followed by 1% adjustment after that, to a maximum of 5% above the initial rate. Our ARMs will adjust every 6 months after the initial fixed period. Okay, so 7-year ARM, rates fixed for 7 years. Starting in year 8, that rate could begin to adjust every 6 months. The 7-year and 10-year ARM are 515 format, so 5% the initial adjustment potentially, 1% each adjustment after that, 5% overall. Now, what would dictate what those rates are ultimately going to be when they do start to adjust? A lender will establish an index, and then they will add a margin to that index. Okay, the index that lenders are going to use these days is called Standard Overnight Financing Rate, SOFR, Standard Overnight Financing Rate. Okay, they're then going to add their margin to that. Margin is typically 2.75%. So starting in year 8 for like a 7-year fixed ARM, what is the index? What is that SOFR, Standard Overnight Financing Rate? Add 2.75% to that, and that would be your rate for the next 6 months starting in the adjustment period. Now, why would anybody pursue an ARM? Well, ARMs typically have rates that are lower than a 30-year fixed. So right now, when rates are elevated, 30-year fixed today, runs around 7% approximately. Why would somebody pursue an ARM? Well, maybe ARM rates are lower, right? Another reason somebody might pursue an ARM is if they're looking at a portfolio loan. Lenders don't love to have their money tied up for 30 years. Okay. Fannie Mae, Freddie Mac, FHA, VA, USDA, they all love 30-year fixed mortgages. They don't mind because they do so much volume, right? They do the vast majority of mortgages across the country. An owned private, lender or credit union, bank, credit union, they're not going to be as keen on tying up that money for 30 years. Okay. So they typically will do an adjustable rate mortgage on their portfolio. Credit cards are a great example of that. Credit cards are almost always adjustable rates. They're going to adjust and fluctuate based on the market rates. Another reason somebody might pursue an ARM is maybe they're only going to be here for 5 years. We get people here on work visas all the time, like, oh yeah, I don't need necessarily a 30-year mortgage. I really only care about what the rate is going to be for the first 5 years because I have to be out of the country within 5 years. Great, a 7-year fixed ARM or a 5-year fixed ARM might be a perfectly viable option. Now, within the mortgages, lenders care about your credit score. Okay, we call it the 3 C's. Lenders care about credit, collateral, and capacity. The 3 C's of getting a mortgage. I think when you buy a diamond ring, there's 4 C's. When you get a mortgage, there's only 3. Credit, capacity, collateral. Now, mortgage lenders are all going to look at what we call FICO, Fair Isaac and Company. That's what that stands for. And we're specifically looking at FICO Model 8. It's the latest iteration of FICO scores. Now, your credit score, your FICO score specifically, is going to be broken up into 5 different pieces. Okay. Payment history is 35% of your FICO score. Have you made your payments on time? Okay, that's simply what that means. Have you made your payments on time? 30% of your score is amounts owed. What that really should say is amounts owed relative to the amount you could owe. Specifically, think about a credit card. Okay, you have your limit. You have a credit limit of $10,000, let's say. Well, how much are you using of that available limit? Okay, that's what they're looking at. Anytime your balance to limit ratio creeps up over 33%, your score is going to start to drop. If it creeps up over 50%, your score is really going to drop. Okay, so making sure that you're not utilizing any more than 33% of your available limit on your credit card is going to give you the best credit score. To that end, we tend to notice right around now that credit scores tend to be at their lowest point. It's because all those holiday bills, all those travel expenses and holiday gifts, all that stuff was charged up on a credit card. And oftentimes people creeped up over 30% of their limit. Score is going to start to drop. If you go over 50%, it's really going to drop. Why would that impact your score? Well, from FICO's perspective, if you're utilizing most of your limit on your credit cards, you might be in tough shape. Okay, you might be facing tough times. You might be running up against it a little bit. If people are maxing out their credit cards, it's not really a good indicator of payment history going forward. So amounts owed relative to the amounts you could owe specifically on credit cards is a huge portion of your credit score. Simplest and quickest way to improve your credit score is to get your credit cards paid down to less than 33% of the limit. Within 30 days, you'll notice an improvement to your credit score. So if you notice some gigantic swings in your credit score month to month, it almost guaranteed has to do with that. One way you can improve it, pay your credit card bill before the bill comes due. People tell me all the time, oh, I pay off my credit card in full. Well, whenever that credit card statement generates, that's the information that gets passed along. So unless you're paying your bill before that bill generates, they're getting the information of what your bill showed, not necessarily what you are doing. So paying your bill before it comes due. Increasing your limit is another option. If you have like a Kohl's card or a JC Penney card, a store card with like a really low limit, that's gonna kind of work against you a little bit. If you can improve that limit, it's going to be harder to creep up over 33% of that limit. It's going to improve your credit score as well. The only downside to it is now you have access to that credit. So if you trust yourself, it's a great option. If you don't, fair enough. 15% of your score is length of credit history. Okay. How long have you had accounts open for? You'll hear people say you should never close out a credit card because it's going to hurt your credit score. They're specifically talking about that 15%. Okay. Credit cards tend to be your oldest account. Makes a lot of sense, right? If you have a car loan, it's only a 5-year, 7-year loan, right? Mortgage, yeah, it's a 30-year mortgage, but nobody ever has their mortgage for 30 years, right? They refinance, they pay it off, they go buy another house, right? So credit cards tend to be the best thing you can do for your credit score if you're disciplined. Length of credit history, they're going to have the lengthiest account be your credit cards typically. I've had some people with credit cards open since the 90s, right? Very common. Even when they cancel your card and get you a brand new card, it's the same account number. So it's going to have be part of that length of credit history. 10% of your score is new credit. Anytime you open up a new account, it's going to drop your score for the first 6 months. After 6 months, it'll start to improve your score. You've also probably heard people say, hey, you should make sure that you limit how many people check your credit. Okay. Well, they're also talking about that 10% right there as well. Anytime somebody checks your credit with the intent of extending credit, it's going to drop your score between 3 and 5 points. They do have 2 exceptions to that. One is for mortgages and one is for car loans. If car loan lenders or mortgage lenders pull your credit within a 14-day window, it is only going to count as 1 credit inquiry and ultimately only 1 ding against your score between, again, 3 to 5 points. Why would that impact your score? Well, FICO's logic there is if a whole bunch of companies are checking your credit, it means you're probably trying to get access to a bunch of credit. If you're trying to get access to a bunch of credit, it means, again, times may not be going very well. It might mean you're coming up against it. Okay. Types of credit used. Now, this is the craziest part. Okay. Everything I've said so far, you can kind of make heads or tails out of. This one is ludicrous. Okay. They say, and it is really, really crazy. They say you should have 3 credit cards for every 1 non-credit card. Then that's ridiculous. If you have a car loan and a student loan, and ultimately you get a house, that's 3 non-credit cards. They say you should have 9 credit cards. Don't do it. It's only 10% of your score. You can certainly have perfect credit without it. That being said, credit cards are the single best thing you can do for your credit score. Okay. First thing they do when you get referred out to like credit repair and like that is, hey, we should really get you new credit card, get it established, make sure you're not utilizing more than 30% of your limit. Awesome. So besides the actual makeup of the credit score, there are a few things that will matter, okay, when you're trying to get a mortgage. Late payments. If you're currently late on any debt, you really need to get current, okay? Get current, get current, get current. It's going to continue to impede your ability to get any kind of financing. When we get a loan and we run it through Fannie Mae and Freddie Mac's underwriting system, if they see you are currently delinquent on anything, like currently late, it's going to really impede our ability to get an approval. Okay, they are very picky. If you're currently late on a credit card, whatever, what are the chances you're going to be able to make your mortgage payments on time? So get current. As soon as you're current, we should look at it again. Collections. Now, with the latest iteration of FICO Model 8, they have reduced the impact of medical collections on those credit scores. Okay, and I just saw something that came out today from Consumer Protection Bureau that said that they're actually going to start removing those entirely from credit reports with regards to medical debt. But right now, the impact of collections has been somewhat mitigated, especially if it's a medical collection. Now, if you have non-medical collections in the thousands of dollars, likely going to have to get paid off prior to being able to buy a house. Charge-offs. What is a charge-off? A charge-off is you owe a creditor money for long enough that the creditor finally says, we're not going to see this money. They basically just charge it off their books. That's what a charge-off is. They are writing it off their books. They're just taking the L. Okay, they're just taking the loss. Charge-offs, it's not going to necessarily be paid to be able to qualify for a mortgage as long as your credit score is sufficient. However, if they are also in the thousands of dollars, they likely would. So collections and charge-offs, if they're in the thousands of dollars, it's likely going to have to be required to be paid off prior to buying a house. Judgments. Judgments are, you are legally obligated to pay money. It's no longer a creditor saying, hey, you owe us the money. It's the government saying you lost. You owe. Child support is common. Back taxes are very common as well. You lost a lawsuit. You owe somebody money. Now there's a judgment showing up. Judgments are always, always, always required to be paid off prior to being able to buy a house and get a mortgage. So late payments, just get current. Collections and charge-offs, if it's not in the multiple thousands of dollars, likely not a problem so long as the credit score is sufficient. Judgments always have to get paid off. Now, I say credit score is in the adequate territory. What is that? If you're looking at FHA or VA, typically 620 is going to be required. If you're looking at conventional financing, Fannie Mae and Freddie Mac back loans, those are typically going to require a 680. You heard me say typically, okay? There might be lenders out there that will do FHA or VA or USDA below a 620. They're few and far between. They're definitely harder to find. Conventional, Fannie Mae and Freddie Mac, all their guidelines say we want to see a 680. They will also say that, hey, we might be able to go down to a 620 as well if and only if there's strong compensating factors. You're putting a large sum of money down, your debt to income ratio is really good. We're going to be talking about all of that shortly. But typically they want to see a 680. I have seen them go lower if there's strong compensating factors in the file. Down payment. So a mortgage term you're going to see fairly frequently is LTV. That stands for loan to value. Simply put, the loan amount divided by the value of the house. Okay, that is your loan to value. If somebody puts 20% down, their loan to value is 80%. Okay. Now, you'll hear some people say, hey, the minimum down payment is 20%. That's not true. What they're really saying is, hey, if you want to avoid mortgage insurance, it's 20%. Mortgage insurance is the one insurance in your life that you do not want. Okay, people hate mortgage insurance. It's insurance you pay for that protects the lender. Anytime you put less than 20% down on a conventional loan, it is going to be necessary. Okay, so as a first-time home buyer, somebody who's not owned a house in the last 3 years, kind of a weird definition of first-time home buyer, anybody who's not owned a house in the last 3 years. If you have not, you could put as little as 3% down on a house using a conventional mortgage. If you're looking at FHA, you have to do 3.5% down, so 3.5% down. Now, FHA, again, one of the 3 types of mortgages, and one of the reasons we're not spending as much time on it is because FHA requires mortgage insurance forever. If you put 10% down on an FHA mortgage, they only require it for 10 years, only. Not only that, FHA also charges you upfront mortgage insurance and monthly mortgage insurance. So when I say, hey, conventional mortgages are kind of like the gold standard for mortgages, that's what I'm referring to. FHA has more expensive mortgage insurance, hard to get it removed. They charge you both monthly and upfront. It's just generally speaking a less favorable loan type. If we can do conventional, we are totally doing conventional. It's why we're spending a majority of our time talking about conventional. Now, conventional mortgage insurance, the mortgage insurance is on a sliding scale. Here's a great kind of chart to save. And as Allison mentioned, we'll be sending this out afterwards along with the recording. So yeah, Don't worry about writing this down. Feel free to do so if you want, but we'll be sending out the slides. So private mortgage insurance. For every $100,000 in loan amount, not sales price, loan amount. If you put 3% down, it's going to be about $690 per year per $100,000 loan amount. So if you're getting a $300,000 loan amount, just multiply this by 3, divide it by 12 to find out your monthly insurance premium. If you put 5% down, it's less, $440 per $100,000 per year. 10% less, $290. 15% down, $190. Okay. So the more money you put down, the less it is. Once you put 20% down, you no longer have to have it at all on a conventional mortgage. This all assumes like a 740 credit score. Now, people ask the question, well, heck, if I, put 3% down to start, and then I start paying down my loan and I get to 5% equity, does that mean my mortgage insurance premium reduces? The answer is no. It's going to be at until you get it removed entirely. Speaking of which, with the conventional loan, there's 4 ways to remove it. Okay. FHA, again, stuck with it forever. If you put 10% down, you only have to have it for 10 years, hard stop. Conventional, not the case. Okay. Conventional, you can have it removed in a number of different ways. So, termination of mortgage insurance, number 1 scenario, also the worst case scenario, is it'll fall off when you were scheduled to reach 22% equity or a loan to value of 78%. Okay. Now, scheduled is the key word here. It's not when you do reach that, it's when you're scheduled to reach that. So if you put 5% down, it's typically like 10 years into the loan before you're going to reach that point. Okay. Worst case scenario, this is like you fall asleep at the wheel, you make your payments on time, it'll fall off when you're scheduled to reach that point. Number 2. If you refinance and you have 20% equity, you don't have to have it on the new loan. That one's kind of obvious, right? Number 3, within the first 2 years, if you actively pay down your loan and you reach 20% equity or 80% loan to value based on the original value, you can petition to have it removed. Couple keywords there, okay? Number 1, original value, okay? They will not use any appreciated value, how much your house has increased in value. They will not use any of that for the first 2 years. First 2 years, they'll limit it to only using the original value of the house, which is the lesser of purchase price or appraised value. Okay, typically those numbers are one and the same. Second thing in there, at lender's discretion, or you have to petition to remove it. What does that mean? That means the lender is going to require an appraisal. Okay, we're going to need to make sure that the house is not decreased in value. Way, and by far and away the most common. After 2 years, you can now use an appreciated value. So you can now use what that new value is going to be. Then the first 2 years, you cannot. Again, lender discretion, going to have to do an appraisal. Also, you're going to have 25% equity. Why 25% equity or why 22% equity in the first scenario? One thing I know to be true, all insurance companies want their money. Okay. They also are worried about like a California market arising where like pre-2008, the value fluctuations would be huge, like month to month, year to year. Well, they don't want you to all of a sudden like be at 25% equity and then not at 20% equity like the following month. So they build in a little bit of a cushion, a little bit of a buffer in there. Okay. So most common right now is going to be you refinance. Rates are high. People are going to be refinancing hopefully within the next year or two. If you have 20% equity, great. Not going to be required in the new one. Or number 4, after 2 years, we can use new value. And if you have the new equity at that point, we can certainly petition to remove it. I tell folks all the time at closing, hey, make a calendar reminder, follow up with me 2 years from now. We should see if you can remove PMI. So what are the acceptable sources of a down payment? Ultimately, your funds for closing need to be in the form of a savings, checking, or money market account. Those are what we call liquid accounts. Okay, so ultimately you want your money to arrive in one of these 3 types of accounts. They don't have to start there, but they'll want to end up there. You can also use retirement accounts if you want to buy a house. You can take a loan from a 401k, how much you can get access to, what are the terms of withdrawal, all that you're going to want to check with your 401k provider. But most 401ks allow for you to take a loan from your 401k under what they call a financial hardship. Buying a house is considered a financial hardship. I don't know why. There's not a lot of hardship there. But buying a house is considered a financial hardship there. Also, divorce is also typically covered. Now, with a 401k loan, you're borrowing your own money and then you're paying yourself back with interest. It's kind of a weird setup. If you can pay back that loan it's not a bad option, okay? If you do not pay back the loan, then you're going to have some pretty significant tax consequences associated with it. So long as you can be disciplined about it, not a terrible option. Also, worth checking into your 401k. A lot of 401k providers will not let you contribute to that 401k until you've paid back the loan. So they might still take money from your paycheck each month, but it's to pay back the loan, not for additional contributions. I mention that because if you're younger, borrowing money from your 401k and missing out on early years of contributions can, hurt you later on in life. So you don't want to, cut off your nose to spite your face. Roth IRA. With the Roth IRA, you've actually already paid taxes on that money. It is post-tax dollars that you've now invested in an investment account or retirement account. To that end, you can withdraw the amount of money you've contributed. You just can't access the amount of money that your money's made. That makes sense. So if you've contributed $5,000 for 2 years, and your account is now worth $12,000. Okay, so you've contributed 10, your account's now worth 2. With the Roth IRA, you can withdraw the 10. You can't withdraw the additional 2 that you've made on your money. IRAs tend to be rollovers from 401ks. To that end, they also tend to be a little bit harder to access because how are you going to pay back that loan if you're not currently working for that employer? Check with your IRA provider, find out what the terms of withdrawal are, but they do tend to be a little bit harder to access money from. What about non-retirement accounts? Stocks, bonds, mutual funds, perfectly fine. Any brokerage, non-retirement account, you can totally use that money for the purpose of buying a house. You do have to liquidate that money. So you're gonna have to move that money over from their invested form into cash, savings, checking, money market. Gift funds. Gift funds are perfectly fine for buying a house. It does have to be a relative or a familial-like relationship, okay? What are familial-like relationships? Adopted children, or if you are, you have the adopted parent, your parents adopted you, that would be perfectly sufficient. Fiancés work as well. We don't have to see the ring. We don't need to see proof of it. Hey, we need to show pictures that they got down on one knee and proposed. No, you're just filling out a form for us that says, hey, they are my fiance, and they're giving me $15,000 or whatever the case may be. They also allowed for ex-spouses. That's a new relationship status that's now covered. If an ex-husband or an ex-wife wants to gift funds so that their ex-spouse can buy a house, perfectly fine. Again, they're going to fill out a letter. We're going to supply the letter. They're going to have to fill it out along with you. Says this is a gift, not a loan. We also have to show the transfer of the funds occurring from one account to the other. Loans against an asset you own, also a viable option. So if you have a car and you don't have a loan on that car, you can take out a loan on that car, a cash out refinance on that vehicle. You can use that to buy a house. However, we do have to calculate that new payment when we calculate your debt to income ratio. Okay, so that would be a viable option as well. It only works against an asset you own, so it has to be a secured loan. You can't just do like a cash advance on a credit card and use that money to buy a house. That would not work. Okay, it has to be tied to an asset. Speaking of the loan payment, how do we calculate how much ultimately you can qualify for? Here's the math that the lender's going to do. The lender's going to be trying to figure out what we call the debt to income ratio. Okay, DTI, debt to income ratio. So we're going to start by calculating your monthly gross income. Okay, how much do you make before deductions, before taxes, before any of that? People always ask, like, oh, no, I'm maxing out my 401k contributions. Don't worry. We're going to look at the pre-tax, pre-deduction numbers when we run our analysis. So don't worry about that. Then you're going to multiply that by, and this is where it gets a little bit complicated, either 35% if you are financially conservative. And I'm not talking politically conservative. I know the conditions that I'm presenting this in. Financially conservative, okay, fiscally conservative. If you like to only spend a small portion of your money on mortgage payments, you are fiscally conservative from my perspective, okay? So multiply that by 35% as a starting point. If you are more aggressive, okay, if your home is where you spend all of your time and energy, you don't really go on a lot of vacations, if you don't have children, you might feel more comfortable pushing the limits a little bit more, okay? A little bit more aggressive. Then you might want to do 50%. a good starting point from a lender's perspective, we usually run with 45. Okay, so monthly gross income times, let's say 0.45. Then we're going to subtract out any monthly debts that show up on your credit report. Okay, credit card payments, whatever that minimum payment is that shows up in your credit card statement, that's what lenders will use for qualification. Not what you do pay each month, what that minimum payment is. Okay, car loan payments. Exception to that is if it's a car loan purchase and you have less than 10 payments, in which case we can exclude that debt entirely. But otherwise, yes, whatever that car loan payment is. Student loan payments. Student loan payments are constantly changing. Between COVID and forbearance and debt forgiveness, they're constantly changing. Whatever payment is showing up on the credit report, we get a count against you. So if you're on income-driven repayments or income-based repayments, that small payment, we get a count against their debt-to-income ratio calculations. If they are in deferment, we have to calculate a payment at 0.5% of the balance. Okay. So if you have $100,000 in student loan debt, that's going to show up at $500 per month we have to count against you. When I do that calculus, whatever remains is the max payment I can qualify you for a house. Okay, so when a lender gets you pre-qualified or pre-approved, that's what we do. Monthly gross income, start with 45% minus your monthly debt payments. Whatever remains is the max housing payment I can qualify you for. Now you can kind of play the home game and figure out what that looks like for you. The only debts that don't show up on the credit report that I do have to take into account are child support payments, spousal maintenance payments, so spousal support, or timeshares. If any of those exist and don't show up on the credit report, we have to add that into the calculus when we do our equation. Now, beyond the mortgage payment, there are some things you need to concern yourself with. Okay, if you're currently renting and you're buying a house, well, yeah, now you're gonna have to maintain that house and take care of your repairs for that house, right? So make sure you're budgeting money for that. There's a number of different rules out there here. One common one is, hey, you should set aside 10% of your mortgage payment towards repairs. You know, it's like any of those kind of rules. It's definitely flawed insofar as a brand new house is going to have brand new warranties and not require as much, right? A much older house, a house that was built in 1920, yeah, it's going to have a lot more that you're probably going to need a budget for that. So plan accordingly. It depends on the age of the house, the style of home. Condos and townhomes, for instance, they have those HOA dues, which takes care of the outside maintenance. So you might not need to budget as much for those. With a single family detached home, all that's going to be on you. Okay. Potentially increasing utilities. Maybe your landlord's paying for utilities. Maybe it's all included in the lease. Or maybe you're simply increasing the size of your house, right? In which case, yeah, you're probably going to also have an increase in utilities. So plan accordingly there. HOA dues, homeowners association dues, right? Anytime you buy a condo or townhome, you're going to belong to a homeowners association. Whether you want to or not, you belong to it, okay? With an HOA, yeah, those HOA dues are going to increase, and they are especially increasing right now. Last year, we saw huge increases in HOA dues because we had Marshall fires along the Front Range. I'm currently in Broomfield. I live in Boulder County, and I grew up in Superior, Colorado. So yeah, well aware of all of that. Yeah, a lot of condo complexes, townhomes suffered some pretty significant insurance claims. And because of that, their HOA dues have skyrocketed. Between the Marshall fires and hail damage, it was kind of a rough couple of years, the last couple of years. Now, knock on wood, last year, again, knock on wood, was pretty good for hail. We didn't see as much hail as we have in years prior. Also, fortunately, not a lot of fires. Not saying none, but fewer than we've seen the years prior to that. So hopefully with a couple more years of good insurance claims, some of those claims will start to go down. Some of those insurance premiums will start to go down. So knock on wood, hopefully there. All right. No questions yet?
I don't see any. No.
Okay. If you have any questions, please drop them into Allison. She'll aggregate them and let me know. I love the questions. It's my favorite part. So all you're doing is bringing me joy if you ask me a question, I promise. So let's talk about the pre-approval process. Okay, now you kind of know what the lender's looking at. Like I talked about, we look at the 3 C's. Credit, talked about that extensively. Capacity is broken down to debt to income ratio and down payment. We covered both of those. And then the 3rd C is collateral, which we're going to be talking about in a little bit here. When a lender gets you pre-approved, that's exactly what we're looking at. Okay, we're looking at your 3Cs and we're trying to figure out how much you can qualify for. We will fill out an application with you. Most people do it over online. Takes most folks about 15, 20 minutes. It's very easy. So security, number, birthday, to your address history, to your work history, asset information, how much you have and who you have with, pretty basic information that most folks know off the top of their head. We can also do it over the phone if you'd like. Takes us, again, about 15, 20 minutes. Once you get formally pre-approved, we will send you a pre-approval letter that says, hey, look, don't take my word for it, but a lender says I'm in good shape up to this price point. The initial pre-approval letter tends to be for the upper end of what you're looking for. If you say, hey, look, I'm looking at 400 to 600,000, we'll typically do it for that upper limit, that 600,000 if we can. Once you get under contract, or once you find a house rather that you want to pursue and make an offer on, we'll get you a brand new spanking letter that says, hey, look, they're talking about this property, they're looking at this price, we'll get you those details. I don't want to tell a seller, hey, you're qualified for 600,000 if you're making an offer of 450,000, because they're just going to come back and ask you for more money. So the initial letters for the higher end of what you're looking for. After that, we get you a brand new letter specific to the address and price. Again, I don't want to tell them you're qualified for any more than you're planning on making an offer for. Once you get formally pre-approved, and that's kind of the best place to start for looking at homes, your next step will be to find a property. Okay. So selecting a real estate professional. What do you need to look out for? Number one, ask them for references. Okay. A professional real estate agent will be more than happy to give you some names and numbers of satisfied clients that you're welcome to reach out to. Right? Ask them about their experience. How many loans did they, not loans, how many transactions did they close last year? Right? Last year was a down year, but a professional real estate agent will close, one transaction a month. So maybe, 10 to 12 transactions a year. That's a very good real estate agent. The average real estate agent, this is kind of crazy. The average real estate agent will close 1.5 transactions a year. 1.5 transactions a year. What does that tell you? There's a lot of agents out there that do this as a side job. Okay. They drive Uber, they do this, that, and the other. They've got their regular full-time job, and then, they also sell or invest in real estate on the side. The average real estate agent does 1.5 transactions a year. If you are using a real estate agent, you do not want that. Okay. You want somebody that does this as a true professional. I would say bare minimum 6 transactions a year. Honestly, that's kind of low. A really, really good real estate agent will do 10 to 12. Okay. The best of the best, 2 transactions a month. Making the most of the relationship. Communicate clearly and often. This could be like a relationship seminar. Making the most of the relationship. Communication. Always, always, always. Spouse, kids, communication, right? It's the key to everything. Make the most of your relationship, communicate clearly and often. You might feel like you are boring them, that you're giving them too much information. I promise you, you are not. They would much rather know what you like and do not like than to drag you out to 150 homes that don't fit that criteria. All you're doing is making their job easier, okay? Keep track of what you liked and don't like. After a while, all the houses start to blur together. So keep a list of what you do and do not like. Bring a notepad or keep notes in your phone, whatever. Make sure you're keeping track of what you do and do not like. You're not really going to know until you get your feet on the ground. You start to look at properties. What is and is not going to matter to you. You might go in with one, preconceived notion, and then after a while, you're like, oh, turns out that doesn't matter to me as much at all. So keep track of what you do and don't like. You're only going to help your agent out more. Another thing to keep an eye out for is potential pitfalls. Okay, so in Colorado, you cannot be an agent for both a buyer and a seller. Now, why would that be the case? Well, one of a real estate agent's core functions is to negotiate. They can't possibly negotiate for both sides. Reminds me of like a 30 Rock episode where Donahue is like trying to negotiate against himself because he wanted a challenge. Like same thing, like you can't negotiate against yourself. It doesn't work that way. In Colorado, you can become what they call a transaction broker. Transaction broker does not negotiate for either side, but they do work with both parties. Okay, their job, their loyalty lies to the transaction. Their goal is to really bring that transaction to closing. Here's a great example. A transaction broker will give a buyer a bunch of comparable sales in the area. Hey, look, here's all the sales that have happened in the area. But they will not tell you what price you should offer on that home. They will simply say, here's the data, you decide. Okay, you decide on what value you want to make an offer at. They then take that to the seller and say, hey, here's the value that they are offering on that house. What do you say? They can't negotiate for either side. They can only give information basically back and forth. I know a lot of agents that love being a transaction broker because it's the easiest job in the world. I can't do anything or work for anybody. I'm just here for the ride and trying to make this thing get to closing. I've also got some agents that hate being a transaction broker. They say, like, realistically, I can't remove my loyalties. I had a relationship with the seller beforehand, or I've got a relationship with the buyer. I can't possibly work for both parties. It's just not within my ability to do so. So ask your agent, hey, look, what if you had a listing and I fell in love with it? Would you represent me? Would you pass me on to one of your, fellow agents to work against you? Or would you become a transaction broker? Ask them that up front. The chances are pretty slim that they're going to have a listing that checks every box you're looking for and happens to be the right house for you. But better to have that conversation in advance than not. Okay. But yes, in Colorado, you cannot be an agent for both parties. Homes, again, decide what is and is not negotiable for you. Okay. Maybe you have kids. School district might matter a lot. Maybe you've got two people that are working in that house and you need to figure out the commute. Maybe one person can work remotely and one person can't. What is and is not important to you? Okay. Life stage and size of home. Ranch style homes, wonderful, right? Main floor master, you can age in that house without having to worry about stairs, easier to move in and out of. But there's also far fewer of them, right? And because of that, and because of our aging population, they're in much higher demand than a multi-level home. Like, we've all seen those homes where you walk in and you have to go either upstairs or downstairs immediately, what they call like a split level home. Yeah, as a young individual, you might not mind that. Yeah, I don't mind stairs at all. It's good for me, right? As you get older, yeah, that might matter more. Large yard versus small patio, people immediately say, I want a large yard. A large yard has also a lot of maintenance. I got a large driveway right now, and it requires a lot of shoveling. I'm gonna have to go home this afternoon and start shoveling. Yeah. Just keep in mind that your water bills are gonna be more because you have more lawn to have to water. You have to take care of landscaping. All that stuff, costs money. A small patio, yeah, much lower maintenance. I love a large yard. My dogs especially love a large yard, but it's going to be a harder house to age in. That's going to be a lot of upkeep that I'm going to have to pay for in my future, or move to a different house with a smaller patio. New construction versus existing home. Honestly, I should probably come up with a class simply on this one topic. People immediately say, well, I love not new construction. There's definitely advantages and disadvantages to it. I got some people that buy new construction. They only buy new construction. They won't buy anything other than new construction. And then I've got some people that hate it. Why would somebody hate new construction? Higher property taxes is a big one. Okay. Most new construction is going to have what they call a metro taxing district. If you ever see metro taxing district, start asking questions. The chances are that property is going to have significantly higher property taxes than another house. Another problem with new construction, well, these days, homes are kind of built almost on top of one another. Like, there's literally homes where you can open your window, reach out and touch your neighbor's house. Like, they can be very, very close to one another. Land's at a premium in Colorado, right? We are landlocked, but instead of being landlocked by the ocean, we are landlocked by mountains and open space. And that's not going anywhere. So they start building homes closer and closer and closer to each other so they can fit more and more within the same neighborhood. Yeah, I mean, that's not a lot of privacy. New construction, you're going to be moving into a construction site, right? You're going to have, possibly years of construction noise going on. New construction, immature landscaping, younger trees, younger, plants, all that can create, first a house that looks a little bit less, desirable, and also less privacy. Trees don't just, make everything look great. They also give you a little bit more privacy from your neighbors. With new construction, most new construction homes do not come with blinds. So now you're on top of your neighbor with no mature landscaping and they can see you walking around your house naked. So yeah, not everything's great about new construction. Keep that in mind. I like new construction. I've bought new construction myself before, but when you do new construction, it really should be a longer term house for you. And the reason I say that is because I see people make this mistake all the time. They buy new construction. They only want to live there for a couple of years and then they want to move. And when they go to move out, the builder's still building. And if the builder's still building, now you have to compete with your builder when you go to sell your house. Why would somebody buy your house instead of just going to the construction office and asking them for one of theirs? right? Insurance is going to be less on new construction. You get to pick what you want and where you want it on new construction. Those are advantages of new construction. New house comes with new warranties. That's going to be better on new construction as well. So keep that in mind. If you are doing new construction, I do say, look, make sure that you're going to be there either at the very end of the building cycle when they're almost done with new construction, or that you're going to be in that house long term. To that end, a lot of things, kind of like buying a car, right? You don't know what you do and do not want, or what you do and do not need necessarily until you get a car. Same thing with a house. You might say, hey, look, I love a loft. I think it's going to be a great place to work. And then you find out the kids are running around. It's too loud. You can't do any work. Okay, great. Maybe you need a proper office instead of a loft area, right? There's some things that you simply may not know until you've bought a house or two. So to that end, starting with existing homes, figuring out exactly which you do not want. Also, your first house or two tends to be a shorter term stay, right? It's not going to be your forever home. You kind of have to work your way up there. Great. New construction might be a perfect forever home, but maybe you have to do a couple homes in between there first. Tips when visiting property for sale: bring a notebook or make notes in your phone. Take pictures. Everybody's got a smartphone now, so you can just do it on your phone. Why would you take pictures? Well, real estate agents are really good at hiring professional photographers. The home may not look quite as nice as they do online. I mean, it's an online dating, probably a familiar story. Oh, wow, that was different. I didn't know you were a redhead. All your pictures looked like you had brown hair. Same thing when you're looking at a house, right? Make sure you are taking pictures of homes if you need to get a little bit better feel. Second you leave, you're going to forget everything about it because they're going to start to bleed together. Bring a tape measure if you have any specific furniture you need to fit inside a house. Be shocked how few times you get to walk into that home before you actually close on the house. Initial showing, maybe a second showing, your inspection, final walkthrough. You might only be in a house, 2 to 4 times before you actually close on that house. So make your trip work for you. Bring a tape measure, like pool table. If you have like a billiards table and you need to make sure it fits, great. Yeah, bring that tape measure. You're not going to have many opportunities to do so. Ignore easily replaced cosmetic features. They always say paint is cheap. And when they say that, they're not just talking about paint. Carpeting is pretty cheap. Vinyl flooring is pretty cheap. So ignore easily replaced cosmetic features. Easy way to fix it. I bought an investment property a few years ago, and I was like, why is this house still on the market? It was like, during COVID, and, market was just going crazy. And I was like, why is this house still on the market? It makes no sense to me. Very, very nice townhomes out in Brimfield. And the agent was like, the paint, nobody can look past the neon yellow paint. It was like brighter yellow than SpongeBob. I was like, okay, paint is cheap. I can fix that. Isn't that a problem? It's been a great rental. Evaluate storage areas. Make sure it's going to have enough space. I say it all the time, like it's like gas in a empty space. It's just going to fill it up. Like your stuff is just going to fill up with space you get. You think it's not going to? Oh yeah, 2 extra bedrooms. It's going to fill it up. Okay, so make sure you have enough areas to grow into. Walk around outside, look over the exterior, and listen to the neighborhood. My current house, which my wife and I would consider our forever home, I talked to her and I was like, do you ever notice the road noise? It's not terrible, but especially like during the winter, when the area is nice and dense, you can totally hear 287 off in the distance. It's not an impediment, but I didn't notice that going in. I didn't listen to my own advice. You're not going to have many opportunities to do so. So yeah, make sure you're taking advantage of your trip. Home inspection. In Colorado, we call it the Wild Wild West. Okay, you go under contract and then you do your due diligence. So you shoot first and then you ask questions later. Okay, so in Colorado, once you get under contract is when you're actually going to do your home inspection. It's one of the first things you do. Okay, so when you're doing home inspections, one thing you need to know about Colorado is you should keep an eye on for radon. Radon is a radioactive gas that seeps in through the foundation. Cheap to test for. Very, very, very cheap. You can buy your own kits online, test it yourself if you want to. Extremely cheap to test for. A home inspector will also do that for you. It only costs like $100 or $2. Very, very cheap to test for. Expensive to mitigate. If the level is too high, they have to install a fan that runs through your house that pumps the air from your basement typically, or crawl space, outside the house. Okay, so cheap to test for, expensive to mitigate. Make sure you test for it in Colorado if your house has a basement. Okay, bentonite. Bentonite is an expansive clay in the soil along the Front Range. Some areas have been decimated by it. Some areas don't have it at all. It literally goes in veins in the ground. So you might come across one cul-de-sac. Every home has had a structural repair because of bentonite. And then you might go one cul-de-sac over and none of the houses have. Like truly like cul-de-sac to cul-de-sac. Broomfield area, like Miramonte, like right around there. Lackamore, I believe is what it's called. There's plenty of areas where, you know, just a lot of issues with bentonite in the soil and structural issues. Rock Creek, again, subdivision of cul-de-sac to cul-de-sac. Some areas really hit hard by it, other areas not at all. So ask your basic inspector whether or not you should have a structural engineer. Okay, basic inspector will let you know, oh yeah, I see no signs of settling. This house has been around for 15 years. There's no reason to worry about it. Or they might say, hey, look, there's some stuff that we need to check on. There's some cracks in foundation. We really should get somebody out here to take a look. Structural engineer, going to cost you more money, but your basic inspector will let you know if it's probably deemed warrantable or not. Mold. We did not have any mold issues really in Colorado until 2013. That's when we had the flood. And all of a sudden mold started popping up left and right. Same thing as kind of bentonite. Your basic inspector will let you know if they see any like red flags for mold. If they do, they'll let you know, and you might need to do a mold test as well. Okay. So keep all that in mind, especially along the Front Range. Special considerations if you're looking at condos or townhome. Is there adequate parking? Don't revisit the same time every single time. Okay. If you continue to go to that house at noon, on a weekday, yeah, of course there's adequate parking. Everybody's at work. Okay. Try revisiting in the evening. If you do your first inspection at noon on a weekday, try scheduling your second inspection for or your second viewing, maybe your inspection even for, after hours. Okay. See if you can see that house in a different light. Shared walls, ceilings, floors. Try to visit when your neighbors might be home. Same thing. If you're constantly going in at noon on a weekday, it's going to be very, very quiet. Try visiting at 6:30, 7 o'clock one day. See if that changes your perspective of it all. Are the common areas well maintained? Green belts, the shrubs, the tennis courts, the pool. Is all that stuff taken care of well because your HOA dues are paying for it? You want to make sure your money's going where it should be going. And when you're looking at an HOA, you're going to receive what they call CIC documents, Common Interest Community Documents. Okay, it's going to have the rules and regulations for the HOA, the covenants associated with it. Read them carefully. Trust me, trust me, trust me, trust me, trust me. Read them carefully. You might be surprised what you can and cannot do with your property. I've had numerous people not listen to this advice. They ended up buying a property and then they found out later on they only allowed for, 2 dogs up to like 50 pounds each. And they had, 3 dogs, or they had dogs that were over that 50-pound marker. They literally had to come up with the decision of, do I give up one of my dogs? Love dogs. I will cross the street to pet a dog. I could never have that situation arise. I might have to sell. Don't be stuck in that situation. Make sure you're reading those rules and regulations carefully because they will impact you directly. And then condos specifically, there's additional rules associated. 0, 5, 10, 15, 20, 35. What the heck is all this? Let's take a look. Okay. So when you're buying a condo, condos only, not townhomes. Okay. Townhome, you own the land you're on, that piece of dirt. The condo, you do not. Okay. With the condo, they have to meet these very specific requirements or they are not going to be what they call warrantable. What does warrantable mean? Warrantable means the condo complex does not meet the government's requirements for lending. Okay. It's going to limit your loan availability options, what you can get, what the financing terms are. It's going to impact that a lot. Okay. So the rule of 0, the complex cannot be in any litigation. Okay. They do not want the HOA to have to face a significant financial hardship in the future. So builder defects, maybe the builder had some defects in the complex. Maybe the HOA is suing that builder for repairs or money. Yeah, that's going to be kind of a hard stop, most likely. There's always exceptions of this. If it's minor litigation, hey, somebody slipped and fell and they're suing the HOA for $10,000. Okay, they can probably move past that and continue moving on. But typical litigation is going to be a problem. It can also not be what they call a condotel. What is a condotel? A condotel, they exist mostly in the resort towns. It is a condo that looks like both a condo and a hotel simultaneously. What does that mean? You might walk in and they might have a concierge desk. condotel. They might have a short-term rental desk where you can literally walk up to the front counter and say, hey, do you have any rooms for rent? I'd like to rent it for the week. That's a condotel. Okay. Housekeeping service, telltale sign of a condotel. Okay. If it has the features of a condo and a hotel, it's a condotel. If it's a condotel, Fannie Mae and Freddie Mac don't want anything to do with it. Okay. 5, the insurance deductible for the HOA cannot exceed 5%. This one, I honestly even didn't have in this presentation a year ago. It's come about a lot lately. What happened was, again, Marshall fires plus hail damage the last few years. All of a sudden, insurance premiums skyrocketed, and these HOAs, they didn't know how to deal with it. Either we can increase HOA dues, which nobody wants. We can do a special assessment, which is temporarily increasing HOA dues, which nobody wants. Or maybe we just change the deductible in our insurance policy. Oftentimes they did that, and sometimes they did it and they exceeded the 5% limit, and all of a sudden those HOAs are no longer warrantable. The complex must be setting aside at least 10% of their money for reserves if and only if you're putting less than 10% down. If you're putting 10% or more down, we don't care how much is being set aside for reserves. 15, the complex cannot have 15% or more of the units be delinquent on HOA dues by 60 days or more. This doesn't come up too frequently. We came across it very briefly during COVID-19, during people were losing their jobs and it was kind of rough. This was coming up occasionally. We also saw this post 2008 Great Recession. It also used to be 30 days, not 60 days, and then we saw far more frequent than we do now. This comes up very infrequently now. 20. The complex cannot have one owner who owns more than 20% of the units. They do carve out an exception if it's a municipality or an affordable housing program. They are allowed to own more than 20% of the units. The government's not really worried about them going bankrupt. They are worried about one single individual owner owning more than 20% of the units, and then they go into bankruptcy. They flood the market with a whole bunch of units. It drags down your value. 35. The complex cannot have 35% or more of the square footage be commercial in nature. Fannie Mae and Freddie Mac, they are in the business of residential mortgages. They are not in the business of commercial mortgages. To that end, they really don't have a lot of interest in doing commercial financing. Okay, so less than 35%. That's relevant. That comes up fairly frequently now. A lot of areas are doing, kind of commercial zoning on like the lower level and then residential units above it. The other problem with commercial is those units can be vacant for quite a long time, right? You might see, some storefronts that have been vacant for, years now. Well, that's not great for reselling your house. Does anybody going to want to move above a vacant storefront? It could be that they're going to put a Whole Foods in there and everybody's really happy. It could be a chiropractor's office and really not a nuisance, or it could be a gun range or a bowling alley, something that's very loud, right? So that's why Fannie Mae and Freddie Mac don't want to do this. If it's more than 35% commercial, we have to look at different financial options. And then sometimes 50. This only applies if it's an investor, and if that investor is putting less than 25% down. If that is the case, at least 50% of the units must be owner-occupied. Okay. If any lender tells you something different than this, hang up the phone and call me, okay? They have what they call an overlay, which is a requirement above and beyond what the government requires. They have their own requirements above and beyond that. Elevations doesn't have any overlays. We have far fewer lawyers, and because of that, easier guidelines as a general rule. So, you spoke with me. We got you pre-approved, figured out what your upper limit is, started to look at homes, you interviewed real estate agents. Now you want to go make an offer on a house. What does that process look like? Your real estate agent is going to help you decide what price to offer. They're going to look at what the other sales in the area have been, what the market's doing currently, and based on that, what you should offer on that house. They're going to also talk to you about seller concessions. Seller concessions is where the seller pays for some of your closing costs on your behalf. Okay. The real estate agent is going to walk you through a purchase contract. Purchase contract in Colorado is a standard form. They're going to help you fill it all out. It's about 26, 27 pages, depending on how many documents are associated with it. It is a standard form in Colorado that's really, really nice because it means you're not going to have to worry about drawing up your own contract. The exception to this is when you buy new construction. Builders have a lot of lawyers. Instead of signing a standard state contract of 26 pages, you're going to be signing their contract, which gives them a lot of protection, you very, very, very little. It's not uncommon to see those pages go up to 100 pages. It's actually pretty common to see that. So standard contract in Colorado is very, standardized, smaller. It's actually also very buyer friendly. Builder, new construction, not the case. DAC is definitely stacked for them. You're ready to submit your earnest money. Now, what is earnest money? It is a deposit you make at the very beginning, within a couple of days of going under contract. It's typically around 1% of the sales price. Around is key. It is negotiable. It is up to the terms of the contract. But if you're buying a $300,000 property, it's very common to see it around $3,000. Okay. It shows that you're proceeding in good faith, that you're proceeding in earnest. That's where it gets its name. You're proceeding in earnest. Now, if you do what the contract says you're supposed to do within the time frame given in that contract, your earnest money will not be put at risk. Okay. You're going to do your inspection. If you do not like your inspection results and you cancel by the inspection deadline, great. You can get your earnest money back. Okay. Get your appraisal done. We do the appraisal. You do the inspection. We do the appraisal. If you don't like the results of that, if it doesn't appraise, cancel. You get your earnest money back. Loan terms deadline. At the sole subjective discretion of you. If you do not like the loan terms, if you can no longer afford the house because rates rose, great. You can cancel. You can get your earnest money back. Like I said, the Colorado contract is very, very buyer friendly. I've only seen earnest money sacrificed one time in 16 years. Okay. And that was somebody that bought the house without seeing it. And the first time seeing the house was when they went to do their final walkthrough like a day before closing. And when they did, they said, yeah, I can't live here. And they walked away from, at that time, it was like $15,000 earnest money check. So unless you're doing something crazy like buying a house without seeing it, you don't really have to worry about it as long as you have the right agent and the right lender involved. Okay. We will get you an updated pre-approval letter, like I said, specific to the address and price. I don't want to tell them you're qualified for any more than you're making an offer for. Then your agent will submit the pre-approval letter and that contract to the seller. Expect a counteroffer. Okay. Almost always we see a counteroffer. Sometimes it's very insignificant. Oh, well, we have to change the name of the seller. They have their title in a trust or something. Or, hey, we want to move closing back a couple days because they're traveling for vacation. Great. Not a big deal. Expect a counteroffer, though. If you sign that counteroffer, you will officially be under contract. Okay. Now that you're under contract, we need to make sure your application's up to date. It might have been 2 days since we got you pre-approved. It could also be a year. Okay. All ends of the spectrum there. So we're going to need to make sure everything stayed the same. Nothing drastically has changed. You'll give us a copy of the contract. I'll get you some updated loan numbers and discuss various different options available to you. We will discuss whether or not it's advisable to lock in your rate or whether we should float the rate. If you lock in the rate, your rate's protected. You no longer have to worry about rates rising. You are protected. If you float the rate, you are rolling the dice, going to gamble a little bit and see what rates do between now and closing. I tell people all the time, I have a crystal ball. My only problem is it only looks 1 day ahead. I can see what's going on in the mortgage-backed securities market right now and tell you what I think is going to happen in rates tomorrow. But it only does do 1 day at a time. It only does look 1 day ahead. We'll discuss that strategy when the time comes. We will provide some loan disclosures for you. Okay. Copy your formal loan estimate, notice of intent to proceed. Your loan application that you fill out, you're going to have to sign that digitally. We will supply that to you. You'll electronically sign it all. Then we're going to get the documentation from you. Updated pay stubs, 30 days worth. Updated W-2s, we have to have the most recent 2 years of W-2s. 60 days of bank statements. We're going to get all that documentation from you. Okay. We are then going to submit that for the underwriter. More on that in just a second. Once you get under contract, you're going to have a couple days to drop off that earnest money check. You will immediately schedule your home inspection. Okay, your real estate agent will have some recommendations. If they don't, I've got a name or two I can give you. While you do the inspection, concerns themselves about the condition of the property, the lender will do an appraisal. What is the appraisal? Appraisal is a valuation of the home. Anytime a lender is lending 97% or 95% of the value of something, we want to make sure it's worth what you're paying for. Okay, we have a very limited panel of appraisers, and that's intentional. Okay. We do not want an appraiser to come from Colorado Springs to Longmont to appraise a house, from Longmont to Colorado Springs to appraise a house. Very different markets. They need to know what's going on in the immediate area. We limit the appraisers to only work in a couple zip codes. Okay. We also have vetted this panel in advance. Okay. Our senior vice president of mortgage used to be an appraiser. She's very, very picky about who she has on her panel. An appraiser is a reflection of the institution, right? If they show up in, board shorts and flip-flops and they do a bad job, it reflects poorly on us. To that end, we keep our panel pretty dialed in, the best of the best appraisers. We cannot pick the specific appraiser, okay? That is forbidden because what happens is lenders used to pick their favorite appraiser and say, hey, look, go make the house worth this. By not being able to pick a specific appraiser, but only keeping it to a panel of appraisers, there's significantly less incidence of a lender trying to skew the values. Okay. If that appraisal comes in high, good news, you have more equity walking into the property. Also good news, you're the only one that knows about it. I do not want to tell a seller that the house appraised high. It's going to ruin your leverage during the process. So we specifically send out an email that says appraisal in at value. Very, very vague. And I get people all the time that can push back and say, that's great, but what value? And my response is always the same. I cannot tell you. The seller or the buyer is aware. They're the only ones that are aware. Suffice to say, it's sufficient for our purposes. And once they hear that, they're pretty much fine with it. Like, fine. Try to pull one over us. It didn't work. Upwards and onwards. What if it comes in low? A few different things can happen. Okay. One, you could ask the seller to reduce the price. Hey, we're under contract at $400,000. Property appraised for $390,000. We now want to buy it for $390,000. Make it worth $390,000. Okay. That's be an option. Some agents love having a low appraisal because they can go to work. They love leverage. They're master negotiators and they can go to work and try and negotiate you a better price. Some agents hate low appraisals because it's another, speed bump to get over. But most professional agents have come across it multiple times and they are well versed in it. Appraisers are also human. We can also go back to the appraiser and ask for a reconsideration of value. Hey, we disagree about your valuation because of this, that, the other. Maybe they missed a sale. Maybe there was a sale that was off market. But we can always go back to the appraiser and ask for a reconsideration of value. You could also bring more money to closing. Okay, we saw a lot of that during COVID-19, a lot of frothiness in the market. Homes, every single sale that was happening was selling above the previous one, and appraisers were struggling to kind of keep up with things. An appraiser's job is to look backwards, not necessarily forwards to where things are going, but only backwards to where things were. So during the spring market, when we see a little bit more demand, yeah, it's not uncommon to see a low appraisal or two. You could bring more money to closing to make the deal work. You could also split the difference. Hey, house appraised for $390,000. We're under contract at $400,000. We'll split the difference. What about $395,000? Okay, so compromise could be struck. You could also cancel and walk away. If you kept all your deadlines intact, you could cancel at that time and walk away. Hey, the house appraised didn't appraise. We're just going to go ahead and move on to a different one. Okay. In the process, do not apply for new credit during the process. It used to be the cool thing to do would be to drive a new car to the new house closing. And then 2008 happened, right? Housing bubble pops. All of a sudden, the government started to ask more questions like, did we take into account that new car payment when we qualified them for this new house payment? And the answer was always no. Now, when we pull credit, it shows anybody who's checked your credit in the last 120 days. We have to find out why they checked your credit. In addition, 7 days before closing, we have to do a credit refresh. We're not getting a brand new score, so don't worry about that. But we do have to see who checked your credit since we started. Could be an insurance company did it because you were shopping around for insurance. Could also be you were in Home Depot and they had a Martin Luther King Jr. sale, day sale, and all of a sudden like they're offering their appliances half off, and you want to take advantage of it, right? Yeah. Well, we have to take into account any new trade lines. Okay, so that we would find out about it. The moral of that story is just let your lender know. We'll let you know if it's a big deal or not. I had a member yesterday, quite literally yesterday, asked me, hey, I need to buy some appliances. Is it okay if I do so? Their debt to income ratio is fine. I was like, hey, perfectly fine to go ahead and do so long as you're using accounts you already have, credit cards you already have. If you want to open up a new credit card, I would advise against it. It could potentially delay closing if we have to try to add that credit card to your credit report at the very, very end. Or just talk to your lender and we might say, hey, we're well enough in advance. Go ahead and do it now. Save all your paperwork. We're going to have our credit company reach out to you to add that. Don't make any unnecessarily large purchases, withdrawals, or especially deposits. Deposits are the big one, okay? Anytime you deposit a large amount into your account that's not typical payroll and it's not clearly, documented, it's going to be an issue, okay? The government is really worried, and all these loans are government-backed in one way or another. Fannie Mae and Freddie Mac are government-sponsored enterprise. FHA, Federal Housing Administration, truly Uncle Sam, okay? Even portfolio loans. Well, it's the credit union's money at that point. We are backed by NCUA, right? all these institutions are backed by the government in one way or another. What they're worried about with a large deposit is that you sold drugs and now you're going to go buy a house with drug money. And they just lent money on a house that was purchased with drug money. That's like the government's worst nightmare. Okay. So if it's a large deposit defined as typically more than 50% of your typical pay, we have to find out where that money came from. There's also some underwriter discretion there. Okay. If you have multiple smaller deposits that add up to 50%, they can also ask that. I had a member be like, oh, great. Well, 50% of my pay is, $2,500. So I'm just going to do 500, 500, 500, 500, 500. It's not going to work either. Okay. Have a conversation with your lender. If you do have money you need to deposit, chat with us first. I'll tell you the right way and the wrong way to do it, what documentation we're going to need so you can document it. Please provide the documentation as soon as possible. We typically say once you're under contract, we're going to get you that list within the same day. If you can get it to us within 3 days, that'd be great. It allows us to keep everything on track, or heck, maybe even move up closing if we have time to spare. So we get you that list of what we need. You schedule your inspection. We schedule the appraisal. Once you get that list of what we need from you, get us that documentation. We're then going to submit it to the underwriter. The underwriter's job is to make sure that the documentation we provided meets those government guidelines that I've vetted in advance. Now, a good loan officer, their reputation is built about getting loans approved, not denied. To that end, I do that due diligence in advance. Okay. If I have any questions or concerns on your application, we're going to have that conversation well before you make an offer on a house, well before you go under contract on a house, right? I want to make sure that we are documenting everything correctly, that you are a good candidate for a mortgage before I put you through the rigmarole and the costs of paying for inspections and all that. Okay. Once we get that documentation, we're going to put it in a nice orderly manner. That's what our processor does. Their job is to then submit it to the underwriter, whose job is to make sure that everything meets the government's guidelines documentation-wise. They will issue what's called a conditional loan approval. Hey, great, the loan's approved pending. We still need that appraisal back. And oh, they need to finalize their insurance policy. And oh, we got one pay stub, but we need one more. Great. We'll let you know what else we need. You'll get us that additional documentation. We will send your loan back to underwriting for final sign-off. Okay, final loan approval, also known as clear to close. Once you're clear to close, we will send you your final loan numbers. Okay, we will work with the title company to make sure those numbers are finalized. We will send those numbers to you. I will let you know they're final. You will get either a cashier's check or a wire sent to title for that money. The money does not go to the credit union, it goes to the title company. Okay. Title company will balance with us, approve the final figures. Title company's job is a few different pieces. Okay. Number one, they collect funds and they release funds. That earnest money check we talked about, typically about 1% of the sales price deposit within a couple of days of going under contract. The title company will hold on to that. Okay. They are an in-between third-party company that works both with the buyer and with the seller. They don't work for either person, they work for both parties. Okay. They will hold on to that money. Upon successful closing, that earnest money will get credited towards your cash to closing. You're going to be bringing $50,000 to close and you already spent $5,000 in earnest money, you'll bring $45,000 to closing. Okay, so it will ultimately end up as a credit towards your cash to closing. The title company's job is to make sure that everybody's doing what they say they're going to do. They collect funds, they disperse funds, they execute closing itself. You will physically go to the title company for closing. The notary will, the title rep will sit at the end of the table, explain the documents you're signing, have you sign it. They then notarize it, and then they record it with the county after closing. So they handle the physical act of closing itself. The last thing they do is they do what's called title insurance. They will go back through the chain of title to make sure nobody was committing fraud, buyer, seller, all the way down the line to you to make sure that everybody did their jobs correctly, everybody had the right to convey that property, and nobody's committing fraud. Number of horror stories before the 2008 housing bubble popping, where a seller would sell the same property multiple times to different people. That's bad. You don't want to be out your life savings. We certainly don't want to lend money on a house that you don't have the ability to buy. And also make sure that nobody can come knocking on your door after closing. Hey, this is my house. No, title insurance protects you. Make sure that doesn't happen. Okay. Like I said, you will physically go to the title company. We allow you to electronically sign the vast majority of the documents ahead of time. If you do that, closing is very short. I was at a closing yesterday. It literally was wrapped up in 20 minutes. So it can be very fast if you e-sign. If you don't e-sign, budget about an hour. Again, Wild West in Colorado, everything happens at the table. You sign on the dotted line, you turn over your check, you get keys to the house. Same day. Same day. There's no what they call escrow period. Everything happens quite literally the same day. Very unique, very unique. Some states, they require you to have like a mandatory waiting period of like 3 days. You have to wait for the close of escrow. It's kind of anticlimactic. You deposit your funds and you just have to wait around waiting for the dust to settle. Not the case in Colorado. The dust settles immediately. That is it. You sign on the dotted line, you turn over your money. You have officially bought a house. This is all my contact information, my cell phone, my email, everything. If you have any questions at all, let me know. I love the education part of it. It's my favorite part of what I do. I really, really, really do enjoy it. I just enjoy serving people and helping people out. So I'd love to help you. If there's anything I can do for you, let me know. Yeah, Allison, any questions at all? I'm going to take a deep breath and drink some tea.
Yes, absolutely. Right now I don't see anything in the Q&A or the chat. We can give it a minute though.
Yeah, please. We're a few minutes ahead of schedule. If you have any questions, let us know. Allison, what did you do for New Year's?
We have a farm in Kansas, so we went out there and hung out in Kansas.
Did you make it to midnight?
We were driving, so we drove in at like 1 a.m. So we were on the road. Yeah, that's cool.
No questions. No questions.
No.
Nobody wants to make me happy? Nobody. I love questions.
Unless I'm not seeing them. Nope, there's nothing yet.
Okay. Well, if you guys think of anything at all, let us know. Anytime, hit us up. Happy to help, literally however I can. So, thank you all so much for spending your lunch with us.
Yeah, thank you so much, Aaron. And like we've said a couple of times, I'll go ahead and email this presentation and PowerPoint tomorrow morning.
Appreciate you all. Thank you.
Thank you. See ya.